Oftentimes, a buyer at a closing will hear his attorney tell him he has the right to prepay a portion of his mortgage every month. The vast majority of mortgages these days allow for an extra payment to be made towards principal. This may or may not be a good strategy. First of all, a buyer should realize that mortgage interest is deductible when you file your income taxes. That's good news. You get a tax deduction, a tax break on the interest that you pay. At this point, I want to emphasize that I am not a tax attorney or CPA. For proper tax advice, you should talk to your own tax advisor. Remember, every person's situation is different, so don't rely solely on the information contained in this video. Anyway, whether prepaying on your mortgage is a good thing will in large part depend on what other debts you have and what alternatives you have concerning where you put your money. Because mortgage interest is tax deductible, the benefit you get from paying mortgage interest is exaggerated compared to other interest. If you have a relatively low interest rate on your mortgage, you are borrowing money very cheaply. So it probably makes sense to pay off higher interest rate borrowing, such as credit cards, car loans, or personal loans, and the like, before you prepay your mortgage. Okay, let's say you have no other debt, and you have the choices of paying down your mortgage, putting money in the bank, or investing in the next Google. Your decision becomes an investment choice and will be determined by the amount of risk each choice has as compared with the return that you could potentially get for taking the risk. If you are in the enviable position of having money burning a hole in your pocket, your first action should probably be to educate yourself on different investment alternatives, along with speaking to an investment advisor. Anyway, back to our original premise. How much does a monthly prepayment on your mortgage save you? Well, I've made some calculations which show you how much faster you will pay off a 30-year mortgage if your monthly payment is slightly more every month. Take a look at this chart. And this is based on a 30-year fixed-rate mortgage with an interest rate of 4.5%. And as with many TV disclaimers, your interest rate may vary, but you get the idea. If you increase your monthly mortgage payment, and we're talking strictly about P&I, that's the principal and interest portion, nothing to do with taxes, insurance, or monthly PMI, by 5%, you'll pay off the loan in 27 years. If you increase your P&I by 10%, you'll pay the loan off in 25 years. If you increase your monthly payment by 25%, that's just for P&I, you'll pay the loan off in about 20 years. So study this information. If you have any questions, consult with your tax advisor or drop me an email at ask@carllepark.com. If you have a smartphone or a camcorder, email me a video of your question so I can post it along with my answer on my website. Have a great day.